Hi guys, Andrew Lockwood here again. Now, what I found over the years is that there's a consistency in the reasons why many struggle to make it as a trader. And I'm not really talking about the common mistakes, the common reasons that we've all heard about the excessive use of leverage, not using stops, or indeed not having a trading plan. But I want to talk to you today more specifically about the actual buying and selling, where on a chart you should be buying and where you should be selling. We want to show you where to put the high probability trades, only take those trades that offer the best chance of success, and how to avoid the ones that are going to give you higher risk as well. Now, this video is brought to you by our partnering broker, IC Markets. Trade with IC Markets and get access to super tight spreads, fast and easy deposits and withdrawals, 24/7 helpful customer support. Now, if you open an account below using the link, you also can take advantage of our specially arranged commission structure, just $5.50 per lot traded. Right, now let's get to the screens and let's look at these high probability areas of a chart where you should be placing your orders, and also look for the areas that you should be avoiding and staying away. Come on, let's join me now on the charts. Now, I'm sure you've heard that expression in the past that says trading is simple, but just not that easy. Well, I don't think there's a truer statement out there that can reflect the trading business in a more accurate way, which is why I often wonder why many aspiring traders that are coming into the markets for the first time make life so difficult for themselves, putting the odds against them on everything that they do. Now, we've all read the books, we've seen the YouTube videos, we all know about the main reasons why traders fail: the excessive use of leverage, taking on too much risk, not using a stop loss, and not sometimes even having a trading plan. So I'm going to assume that you've at least got that inside your head, and today we're going to talk about the three biggest actual trading reasons why many traders fail when it comes to actually reading a chart. And the first reason, which I think is linked to the other three, is that most traders don't look at the bigger picture. A lot of traders will get fixated on a particular time frame, be it the 1 hour, the 4 hour, the daily, weekly, or whatever it is, but they're unaware of what's going on in the bigger picture. Now, when I'm trading, I'm always looking at the markets with the top-down analysis approach. I'm always looking at the higher time frame, and by doing so, it not only puts the odds in my favor and gives me the higher probability trade setups, but it actually keeps me out of trades as well, which increases my win to loss ratio. So here you can see how I would typically set up my screens. I used the multi-time frame analysis. Now, let's assume that I'm trading on the 1 hour time chart. I always want to be aware of what's going on the 4 hour and indeed the daily. So we start off by plotting our key levels of support and resistance on the higher time frame. And in this example, it's going to be the daily down here in the bottom right. So the best way to plot support and resistance, certainly on the daily and on the higher time frames, is to use the line chart. Now, the line chart reflects the closing price in that particular time period. It shows you who won the battle. It basically ignores the extremes of the wicks. So we like to use the line chart. These are very powerful levels on the daily and certainly on the weekly as well. So it's imperative as a trader that you know exactly where these levels are on the higher time frames. We plot these in at the key turning points, or levels that have been respected on more than one occasion. Perhaps plot one in there as well, and another one goes in there. And then we toggle back to the candlestick chart, and that basically shows you now with the wicks and how the wicks basically were the extremes, but the closing price is the important part. Now, once we've done the daily, we drill down to the 4 hour and do exactly the same. And now the trick is not to place lines at every turn, but just the key levels. Otherwise you'll have more lines on the charts and you'll end up never being able to take a trade. So just click your lines in at the key levels, the key turning points. But as I say, it's imperative that you know what these levels are on the higher time periods from what you're trading. Now, of course, I'm going to be looking at trading on the 1 hour time period. But now I've got these levels on my chart, so I know exactly where levels are of significance, either whether I'm going to trade counter trend off these, or indeed use these lines to keep me out of trades, or indeed for pullbacks into previous support, which often becomes resistance, and previous resistance often becoming support. So when you're trading, it's always worth having a cast to the right of the screen, in my case, to look at the higher time periods to make sure that you're not coming into a key level. Now you need to update these periodically, maybe several times a week. Just go back and replot the 4 hours certainly, and maybe do the daily once a week. I generally like to do mine on a Sunday before the trading week begins. But it's imperative that you know where these key levels are on the multi-time frames. Now another very powerful way of using the higher time frames is to look for price action, certain candlestick pattern formations at key levels. So for example, here on the daily, you see here that we had a very nice bullish pin bar at the bottom of this downtrend, indicating that a trend reversal could be potentially on the way. And indeed, at the top of this trend, we had this bearish pin bar coming in at this level of previous resistance, indicating that a potential trend is reversing again back down on itself. And at the top here, we see a bearish engulfing pattern, again indicating that a potential reversal of trend. In fact, we discussed this. This is one of our strategies, indeed, that we talk about in our trading room every day at forexsignals.com. So check that out if you haven't already done so. Now, I think the number 2 reason why many traders fail in the market when they first take up trading is because they are trying to outwit the market. They're trying to be clever. They're trying to pick tops. They're trying to pick bottoms. They're calling the market overbought, or they're calling the market oversold, trying to predict the exact turning point of a market, which is very, very difficult, even for the experienced trader. What I like to do as a trader, and I've been trading for over 30 years, is to follow the trend. We've all heard the expression, the trend is your friend, and that's the way I like to attack the market on an intraday basis. Typically, I'll have my screens looking something like this. So on the daily and on the 4 hour, I will have the fanned out moving averages. I use the 10, the 20 and the 40 on both these time periods. And I wait to see the markets fanning out and pointing in a particular direction. In this case, they're all pointing up and price is above the moving averages. So I am now only going to be looking for long trades in the dollar against the yen on the hourly time period. Now I'm going to wait for pullbacks in the market. I'm not going to just buy at the top. I'm going to wait for pullbacks and areas of confluence. Look here, this market has been trending up in the 1 hour. There have been opportunities to try and pick tops and bottoms of this market. You could have picked the top there and you could have got 70 pips out of it had you got that one right. You could have picked the top here and got another 70 pips. You could have picked the top here, and if you had picked the bottom, you would have called 40 pips. But it requires a high degree of accuracy to pick these tops and bottoms, these swing highs and their swing lows. Isn't it far better, far more opportunity to go with the trend once you've seen it on the higher time frames and let the market do the work for you, rather than you predict that the turning points are going to happen? Now, a way that I like to get into the market, I like to look for confirmation or confluence. So I like to look for certain price action. I like to see these pin bars. You see one here, you see one here. There's a bigger one here. When prices come back through these levels of moving average levels that I've got drawn in here, or indeed levels of support or resistance that you've got on the higher time frames. Remember we spoke about the higher time frame analysis. When you see these pin bars coming in to these levels, and the market's basically trading lower, and then the bulls take control and push the market back up and closes higher. That's basically a hammer candle or a bullish pin bar. That's a very positive candle. There's another one in there as well, and there's another one in there as well. There's one there as well. So plenty of opportunities to look for areas of confluence. I also like to look at a 50% pullback. It's a very common retracement level. So I'll plot a level of potential support to a recent swing high, and then wait for the market to come back and pull back 50% of that move. That's another level. And when you see price action at that level, like a pin bar or something like that, then that again is a very powerful level in order to enter the market. So areas of confluence with the trend is a very powerful way. Many people make the mistake, common mistake, of trying to pick the swing highs and the swing lows in order to outwit the market. And lastly, the third reason why I think many traders fail in this business is because they are overcomplicating it. They are loading up their screens with massive amounts of indicators. They're out there looking for the holy grails, and they've put all these things on their charts, and then all of a sudden they can't even see the candles for the indicators. That is a real common reason. People are thinking that they found the magic sauce to trading by their certain indicators that's been around for 20 years and has made no one very rich. The best way to trade these markets is to have completely clean charts, to wipe off all these indicators, get yourself back to just pure price action, maybe with a couple of moving averages and at maximum possibly one indicator. But that is a real common problem that a lot of traders have, and I think it needs to be wiped out. So those are the three common areas where people are failing in this business. First of all, they don't look at the bigger picture. They don't analyze the market with the top-down analysis. Secondly, they are not following the trend. Following the trend has its massive advantages for the new trader. Trying to pick tops and bottoms, although it can be done, it's a very, very hard task even for the experienced. And lastly, overcomplication with a mass of indicators. Cut it out. As always, I hope you found this video useful. Give me a thumbs up if you did. Give me a thumbs down if you didn't. As always, leave a comment. I try to get back to as many as I can. Subscribe to the channel if you haven't already done so. And don't forget to follow us on Instagram as well to keep abreast of everything that's going on here at forexsignals.com. Till the next video, happy trading and good luck.